One. Welcome. My name is Roy Maddox, and this is the monthly IBD Meetup monthly overview. Wes and I are the host and facilitators of this monthly webinar, and the Meetup is sponsored by Investors Business Daily. We're one of the largest webinars and meetup groups in the country, sponsored by Investors Business Daily. I'm also the chief market strategist and portfolio manager for Integrated Financial Strategies here in Charlotte. Wes and I are co-portfolio managers. We manage money on a discretionary basis for our clients. Most importantly, I've been practicing CanSlim tactics for over 34 years now, over many different market cycles. As I mentioned earlier, if you're not on our email list and would like to receive our comments, please respond in the chat and provide your email information. We're a private group of almost 2,000 ardent investors who know with 100% certainty that the ability to change their financial lives, it's possible by identifying and owning a few true market leaders. Many of us have done so. We're like-minded individuals who don't believe in a buy and hold methodology. We believe that there are certain times to be in the market and there are certain times to be out of the market, like the current market environment, which is very hostile currently. If as an example, from 2000 to 2002 was certainly a time where you should not have stayed fully invested in the market and ridden your investment portfolio down over 50%. We had the same type of bear market in the great financial crisis in 2007 to 2009. And this 2022 bear market is certainly going down as one of the top 3 worst bear markets that we've ever experienced over my career, over the last 35 years. Tonight, we aim to educate and enlighten and connect like-minded investors in our vibrant online community. We're going to focus on a combination of technical factors and fundamental factors featured in the book, How to Make Money in Stocks by William O'Neill. We'll cover many CanSlim concepts from that book, and we'll utilize some of the educational material that IBD provides to make our points, along with certain resources such as MarketSmith to explain some of our concepts technically on the charts. Most of the comments tonight, most of the discussion will be featured using research from investors.com, and we think you'll find that informational and useful. Tonight's agenda will be divided into 2 different sections. In the first section, we'll talk about the current market environment. We'll talk about our process. We'll talk about some macro concepts, and then Wes will take us through the slide deck where we'll go over some of the useful parts of our process that we think might be useful in helping you and assisting you make some investment decisions. The second half of the program will be used to discuss individual stocks, and it will be just a blitzkrieg of information as we just pull up stock after stock, and we take a look trying to identify some of the market leaders. If you're a novice investment, don't worry about that. Some of our most successful investors and people on this call were novices years ago, but just because of their passion and totally immersing themselves in the market, they've become quite adept at navigating through the market cycles. When I met Bill O'Neill and David Ryan, his protege, in 1988, that really changed my life, changed my career. I knew I was in the presence of greatness then, and I soaked everything that I could over since then regarding CanSlim, tactics, strategy, how to manage money properly and be an astute portfolio manager. So tonight, I hope that the presentation tonight motivates you and inspires you. Remember, this is America, and this bear market is certainly going to end rather soon. And capitalism and innovation will always prevail. So anything is possible if you apply yourself. So again, welcome to the presentation tonight. This is a little bit about our Meetup group. And you can also find us online if you just Google the Charlotte Investor Business Daily Meetup group. We invite you all to sign up and be part of our community. Our disclaimer, just to let you know, the material in this presentation tonight has no regard to specific investment objectives or financial objectives. So it's designed for informational purposes only. It's not to be construed as a solicitation, and nor any of the content that we discussed tonight should be taken as investment advice. Any opinions of the principals of IFS and clients may have positions in the securities that we will go over tonight. And of course, no one accepts any financial responsibility for taking any of the advice as investment advice. We recommend that you contact an investment professional. We're not going to spend a lot of time going through CanSlim. This is featured exclusively in the book, How to Make Money in Stocks by William O'Neill. It's really the Bible of investors.com, and it's certainly a great way to begin your research as you conduct your research, attempting to find these true market leaders that we'll talk about later on tonight. We think that a process should consist of really 3 steps. And the first step is using charts and technical analysis to assist you in terms of making decisions, and then fundamental analysis and also macroeconomic analysis. We think, consider these as 3 legs of a stool. We think each leg is equally important in terms of navigating through the markets correctly. So for technical factors, many of us are very familiar with charts and technical indicators such as the moving average, convergence, divergence indicator, price phase, stochastics, relative strength index. So that's important. We also talk about the trend. You'll hear Wes and I talk about the trend tonight, and we consider the market in a short-term downtrend when the 10-day exponential average is below the 21-day exponential average. We consider the intermediate term in a downtrend when the 21-day is below the 50-day simple moving average. And we consider the long-term trend to be when the market is either above or below the 30-week moving average. So we think trend is very, very important. We also look at breadth, and breadth will provide you some useful information because it provides context so that you can see if the market is truly healthy or unhealthy. And the breadth indicators that we're looking at tonight certainly suggest that the market is hostile, very unhealthy, and we're going to compare the breadth in today's bear market with other bear markets in the past, and we think that will provide you with some useful information. And of course, sentiment is usually measured using investment advisory services, put call ratio, the volatility index, VIX, and other measures. And finally, we're going to look at some ratio analysis that Wes has put together to give you context so you can see where's the money flowing currently. Is the money going into growth, value, small cap, large cap, and so forth? And we think that that's going to be some important information to look at. Again, CanSlim, this is it's the most important elements that go into stock selection. And Bill O'Neill determined those characteristics from decades of studies of the biggest stock market winners in the past. And we think that this is a great place to start your investment research. And again, this is featured exclusively in the book, How to Make Money in Stocks by William O'Neill, which is basically our playbook. Now, one thing has changed over the last 30 years is that many times growth companies don't have actual earnings growth that meets the criteria of 25% earnings growth for the past 3 to 5 years, because a lot of these companies are innovative, certainly, and a lot of these great new emerging companies have been birthed from IPOs, and many IPOs don't have earnings growth as they're constantly putting their earnings back into the company, trying to expand organically. So the most powerful situation that you can have is that when you have triple-digit earnings growth and triple-digit revenue growth, but actually there's only one screen that I'm running right now that only has one stock that meets that objective with strong relative strength currently. And we'll look at some of those screens later on. Okay, macroeconomic analysis. So macroeconomic analysis is modeled through, we've got a partner, Aaii Research, that we subscribe to, and we pay a great amount of attention to his model, and his model simply consists of growth, inflation, and policy. And Keith McCullough has spent years as a hedge fund manager and now conducting research, identifying what groups perform the best in investment cycles, and what sectors perform the best. Right now, Keith has us modeling going into a quad 4 matrix where GDP is declining, and Wes will talk about GDP growth and also deflation, where we think that inflation is certainly peaking and will be moving down from these elevated levels that we're in right now. So in quad 4, and we'll probably go once we get through this market sell-off and this bear market, we'll probably move to a quad 1 sometime next year, the first half of next year, maybe sooner, depending on what happens with the, as the economic data comes out. Okay, and I have a few comments that I wanted to take a look at to give you an update of really how Wes and I see things right now. The market sell-off continued this week, and it was triggered by the Bank of England. And the Bank of England had dislocation in their government bond market, and the Bank of England had to repurchase their government securities to provide stability in the financial markets. This is a result of the poor economic conditions, not just in the U.S. but worldwide, and particularly in these emerging and other emerging countries. The market rally, we had a very short-term oversold rally that only lasted a couple of days, but what people are looking for is they're looking for the Fed pivot or the Fed put or the Fed to pause, and that's simply not going to happen. We've had a number of Fed governors that have come out along with Powell that have echoed that exact point, being that inflation's going to probably stay here longer than we expect, and they're going to continue this tight policy until something breaks. Their target on inflation in Fed funds, we're looking for Fed funds futures to rise to 4.7% by next year, and that's certainly going to put a headwind in the market in primarily long duration growth stocks. So that's important to look at. So the economic conditions are quite robust still in the market, and it's all about the U.S. dollar and interest rates and the Fed. That's going to dictate where the market goes from now. We had some extremely strong growth numbers that came in last Friday, and that's just not the type of those aren't the type of economic numbers that the Fed wants to see for them to stop pausing on interest rates. So certainly keep that in mind. We have a big report. We have a huge report coming out Thursday, and that's the CPI report. The last two times it's come out, it's been quite detrimental in terms of the market. And we're looking for a CPI report north of 8% again. And we think that's going to lead to quite a bit of volatility. So we're personally 100% in cash as we just ride this out. And we think that there's probably about another 15% downside potentially from here. And we'll explain that to you as Wesley takes the reins.
Hey, Roy, question.
Yes, Larry.
What does it mean to break the markets? And I've heard that term a little bit. And is there going to be any concern about how the U.S. markets may, the strength of the dollar, how that may affect, Europe and other international currencies and them breaking?
It's the currency, Larry, that you're talking about that's really the danger. So the US dollar is making not all-time highs, but it's making multi-year highs. And as our dollar strengthens because our interest rates are rising, that is attracting foreign capital. And at the same time, the currency translation makes their currencies less attractive. So all the money is flowing into the dollar right now. The dollar is responsible for about 86% of all economic activity and trading in the world. And so our dollar's strong and all the other foreign currencies are very, very weak. And because of that, we saw this episode that occurred with the Bank of England. And the Bank of England was just told the pension funds in the United Kingdom to clean up all the problem with their debt in the next 3 days. So that just came out today, this afternoon at 1 o'clock. So that's kind of like a potential black swan event. So there are problems with dislocations when people are trying to buy or sell securities. And that's sort of one of these events that can turn into a landslide across the world. So you've got to be very, very careful. But that's what the Fed is certainly, that's what they're trying to accomplish, the same thing, slow down the economy. And they want inflation, they want employment to rise to slow down the economy so they can control wage growth. But the damage of that, the implication of that is they may break something, and that will remain to be seen. But it's going to probably occur pretty quickly.
All right. Can you let me share?
Yes. And
Thank you.
okay, let me turn it over to Wes now. And Wes, just take us through these, please.
Yeah. Okay. So this is an update we've been given, I think, every month, and it's just a history of bear markets. We're looking at the Dow Industrial average, and we've got the most recent bear market highlighted here on this chart, which I think is pretty interesting. You've got duration and percent decline. If we're in a recession here, which we think we are, the decline here for our current bear market in this average is not quite to what we'd expect on an average bear market decline. So, we're looking for one of two things to happen in this environment, and that's, either a significant 10-15% drawdown from here in the Dow Jones, or just an extension to get to something that's more, I guess, typical of a recessionary bear market. One of the things we talked about too, Roy and I, this afternoon, thinking about the possibility of time compression, over the last 30 years or so, with just more data, more internet, more connectivity, and just meaning, maybe it doesn't need to be, these are a lot of these, 09 being an exception, are very, very old bear markets, and maybe the transfer of information can make this a quick, violent, recessionary bear market from here. But if the economy really does continue to deteriorate, then we'd expect there's at least another leg down here. And then Hedgeye, we mentioned earlier, we use their research for macro, and these are their forecasts for GDP the next 4 quarters. So this is a quarter-over-quarter annualized number. In the current quarter, they have some positive growth quarter-over-quarter, and the fourth quarter for now. And then deeper declines based on their models in the first half of next year. And for now, also the Fed nowcast, not sure, we're not totally sure this is a great number to look at, but interesting to see it revised up so much in the last couple of weeks. We think it was a 0.5% growth expectation just a couple of weeks ago. So something has changed there, but this is kind of the, one of those components we were talking about in our in that 2-factor regime model of growth and inflation. Okay, then here's some context for how bad of a start to this year it has been, and we wanted to take a look at the model portfolio performance, so the 60/40 stocks to bonds performance, and this is actually the worst 9 months I think of any year, right? We have this data from 1976 from Carson Investment Research, but this decline is really, really massive. Looking at the history of all this, just with the uniqueness of the raising interest rates into economic slowdown. And just more context too on just the interesting nature of how bad bonds have performed this year. So far, historic year with a drawdown as low as 16.1% based on this U.S. aggregate bond index. So there's been a ton of pain in bonds, something we haven't seen in a long time or ever. And so, we've also been talking about, like, at some point, rates are going to top, and this might be a really, really attractive purchase for us. It's not really our wheelhouse, right? We don't, people are on here for big growth stocks that can change your life, right? That's what we're looking for as well. But at a certain point, you got to realize that, okay, if rates, depending on how high the Fed lets rates go, if it gets to a point where the 10 years at 4.5%, and it's clear that the economy is going into recession, and with and inflation is going to come down and normalize. This is something that we're going to consider for sure, adding to, I think, to our portfolios, even though it's not what we typically would like to do. Okay, and we talked a little bit more, I guess, about when you have really, really bad periods, right? How are you going to have? What does it mean, for the future outlook, right? And so we're looking at the worst 9-month periods here and what might happen. So here we are in this current period. It's 14th on the list of the worst 9-month period of stock returns. And I think our main conclusion here, our takeaway, and something we'll check on the next slide too, kind of related to this, is that the 3-month period from here is a little less certain. But when you have a terrible start or a 9-month period in the market, you can say with some certainty that it's not going to last. The markets do rebound, and these are actually some pretty attractive returns 6 months and 1 year out. But we're still concerned with that last leg down that could be a doozy. So we'll look at something else too here that's kind of making us think the same way. This is some work done by Cpi Capital about what happens when we have these rare back-to-back gains, daily gains in the S&P 500. So we had that big short-term rally last week, where we were up 2.5%, I think, on both those days. And so this is looking at a couple instances where we had those two back-to-back days. And you'll notice that, okay, over the next 6 months, how high did the S&P 500 go from those two gains? And so on average, you could see a maximum 6-month gain of about 10% following those 2 days. So, people look at those breadth thrusts, those indicators. This is kind of what we're trying to figure out. But, after those two significant gains, you also have, some downside risk, right? So the maximum drawdown from those 2 days on average was about 16%. And you can see that, I guess it looks like 9 out of 11 of these occurrences. Actually, you saw that drawdown first, right? So even though you're getting these thrust signals potentially with huge gains in the market these 2 days, there's still actually going to be some risk near term that you actually see a drawdown. That there's somewhat significant 16% drawdown on average following those two days, because I think those 2 days are often going to happen in bear markets, right? You're going to have really volatile upside days in bear markets. That's kind of a characteristic of them. And so, let's just say that looking at October 3rd and 4th, let's extrapolate where we are today to see, following those 2 days, if we might expect a 16% downside move from that bounce, where we might be. And Roy's talked about his downside targets for a while. We've talked about 3,400 just being, the pre-COVID highs. Well, this puts us, if we say it's 16% down from, I guess it was this intra-week high, yes, this last week.
Right. Yes.
Then that puts us at 3,200, right? And that's another, I guess, 10%, maybe 13%. I think it's about 13% down from where we are currently, just to get to that 3,200 level. So it's just, another example of how we're trying to, quantify the downside risk here.
And Wes, let me point something out as well. Yeah. Guys, this is anecdotal, but you do have a number of you've got a number of situations where this has occurred over the last 50 years. So we think that's important, but it's really anecdotal. But where we are from our downside objective, it's also reinforced by the idea that we believe that the market is in a recession currently. Now, the National Bureau of Economic Research, they're going to come out later and say, well, the recession began at peak economic activity at the top, and then they're going to, when it's over, they're going to say this is the bottom of the recession, but that's going to be after the fact. And what concerns us is that the average recessionary bear market has been down 34%, and we're down 25% right now. So if we're not in a recession, or we're not going into a recession, then you can make the case that the market should try to bottom here. But we think that the market is in a recession, and the economic activity is just going to go lower from here. So that's what that opens the door for us seeing 3,000 to 3,200, and a lot of that has to do with companies reporting numbers starting this week. The banks start reporting Friday. We think most of these numbers are going to have to come down. So Wall Street hasn't done that yet, and the valuation is going to take the market down to that 3,000, 3,200 area.
Yep. Yep. Banks should be interesting this week. I'm guessing the reserve number will be interesting. What they're thinking for future losses. Okay, this is something that a friend of ours shared with us, and it's I thought it was a very interesting chart, very, very cool data point. I've never looked at this Aaii stock allocation survey, but it's it's a survey of individual investors who in their current allocations. And then we're also looking at the Michigan Consumer Sentiment Survey. And there's a kind of nice correlation that we're seeing here, where as sentiment goes, so does stock allocation. So we've heard the headlines about the sentiment being at all-time lows, and there it is. And yet there's this huge chasm that's developed between stock allocation and consumer sentiment, and it's just gonna we'll follow up with the bull bear sentiment later on. And it's like, yes, everyone's saying something, right? Everyone's talking like they're bearish, but there's not a lot of action. And we'll talk more about the VIX and the put call ratio, and this is just another piece of evidence that while sentiment's poor, it's people aren't actually doing anything with that. Okay, and this is just a look at inflation. Inflation report coming up, I think Thursday morning, the CPI, and these are hedge eyes forecasts for that. And so this is their quarterly forecast at 8.3% for the third quarter. That kind of implies a September number of about 8.1%. So I think I'm sure people are looking for progress on that. Any sign, any reason to get bullish would be a lower CPI number, but a highly risky and volatile event coming up in 2 days with that. And the big difference here in the forecast that we're using and consensus is just they see inflation becoming stickier, and as that's stickier, that just means the Fed is hawkish for longer, which is the continued risk for the market. And so with that, if they do have to continue to be hawkish, we're just a reminder in the November meeting, early November, there's a 84% chance as of now that we see another 75 basis point rate hike in November. And so, I've been updating this every month too, just to show people what's changed as we look out to Fed funds expectations. And you can see, a big step change in everybody's, or in the forecast of the Fed funds rate going into next year. Basically across the board, everything's up. The February, is up 37 basis points. The middle of July next year is up almost 50 basis points. So, the Fed's communicating that, and it's like markets are continue to kind of not take them at their word until they, continue to pound it in people's heads that they're going to be hawkish, they're going to stay hawkish. And so that's, we'll see. We'll see what happens with the CPI report, here too, because if CPI continues to be in the 8s, it's just going to give them, more reason to continue that trajectory. Okay, and here's this tracking over time what the expectation was for the Fed funds rate in December. So we're near that, or at an all-time high expectation for December. So 2 more meetings, that means 75 and 75 from here to get to that number. All right, and with that, more on yields. We've got the 3-month here at 3.3%. So, it's not inverted from the 3-month to the 10-year yet, just because, the Fed really controls that end of the curve more significantly. So, you should expect that. I think you should expect that to invert at some point, but it's got to be, I guess, within the next meeting or two. So next couple months. And this is a lot of what's fueling the strong dollar, like we were talking about. And it's become an attractive asset to hold short-term dollars that are earning 3.5%. Okay, and here's the look at the yield curve, which we, a lot of people consider a forecaster of recessions. This is a big part of why, what market is the market is signaling a recession, right? The bond market is signaling that there should be a recession in the near future. So, this is as inverted as we've seen it probably in several decades. And just to give you, some context here, looking at the S&P versus this is actually the 5-year Treasury yield, but this is I think a clear indicator of what's really been driving a lot of the bear market in equities is rising interest rate environment. It's just it's becoming more and more attractive to lock in something at 4%, 4% plus. I think the 2-year is maybe a little bit higher than this even, and we think we need to see a top in rates to see a bottom in equities. So that's one signal we're definitely going to be looking at, and we'll look actually here too. This is a 1972 to 1975 chart where there was persistent inflation. So maybe you could call it I mean, everything's a lot different, of course, but it's an inflationary environment with extremely big moves in bond yields. So notice that as soon as rates start ramping up, for a year and a half, although choppy, the equity market just did not work, and there was a significant bear market over that year and 9 months period. And then you'll notice, right, as soon as rates did peak, we were able to put in the bottom shortly thereafter in the equity market. So this is not exactly new, but so that's something to look for. I think it's extremely important, and for now we just don't know how high. We don't know how high the Fed's gonna push it, push the bond market.
And let me just say, Wes, that what we want to see, we want to see a top in rates, and we also want to see a top in the dollar. So that's really what you should be keying off of right now.
Okay, and we'll look at a couple of ratios we were talking about. We're not looking to buy the Qs necessarily at any kind of at the market bottom here. Just looking at the Qs versus the S&P. The S&P, having some things outside of tech, right? And so this has just been a significant decliner from the November top here, where kind of a double top in February of 2021, and then also in November of 2021 as well. And really a similar chart, but just looking at growth versus value. We've seen those commodity names work a little bit better. I don't know what to say about exactly those commodity names continuing to work. It's unclear to me, but I don't think we've got policies in place necessarily to encourage production, which would then hurt prices. So I guess that's kind of what drove, I think, the commodities higher, or commodity stocks higher in 2021, is just the persistence. I'm not sure, but I know that if we do go into a global recession, then oil prices will fall probably significantly from there.
What Wesley?
Yeah.
This is Chris. Either you or Roy can answer this. Like right now, if I had a 2-year look as an investor and say you can get Morgan Stanley at a 4% dividend yield, you can get Intel close to 6% dividend yield, why would the 2-year Treasury be more attractive in y'all opinion than they will?
Yeah. Well,
Downside
they have other risks. They just have a lot more earnings risk. They have risk to cutting dividends in the cycle. That's the first thing that comes to my mind. Do you have something else to add?
Well, the risk in the down in principle, and the stock missing the earnings estimates, and the stock's going down, and then again, cutting their dividends. You know, that's what happens in a recession. And when you start seeing these recessionary numbers, you're going to have companies that you think they're providing you with a great dividend of 6 to 7%, but they're going to have to cut it in two as the stock goes down. So because of that, you've got equity risk there, along with dividend cut risk versus no risk whatsoever if you hold the 2-year treasury to maturity.
Okay. But so I got one more question, a follow-up question on that. So in 2008, companies like that were big, like a Intel or like a Morgan Stanley, just using them as examples, but companies like that were like cutting their dividend down pretty sharply back then when that recession was happening.
Oh, absolutely, they were.
Oh, okay. So I wasn't around. I didn't know. I wasn't trading or investing in.
Yeah, they were on the cusp of going under. They cut their dividends to 0.
Oh, wow. I didn't know that. That's new to me.
Yes, usually if you're seeing it, there's got to be some underlying risk, right? It's not just a free 12% dividend or whatever. It's it's telling you that there's risk there.
Okay, thanks for the information.
Sure.
Okay, and we looked at bonds versus S&P. I mean, we know bonds have performed poorly, but relative to stocks, it's still been a better place to have your money this year. Only down 16%. I think this AGG stock ticker for a bond index down 16%. So, just wanted to show that. And Roy, I was going to let you talk a little bit more. Here's a long-term chart of the S&P and a weekly S&P chart for the last 20-something years. And I wanted to let you go through this and the next one. Yeah.
Okay. This is the S&P weekly, and this is going back, as you can see, 20 years. And what we wanted to point out is the certainly the MACD weekly sell signals, as well as I want you to notice that the red line is the 200 week. And so we're at a level that's quite crucial. And you can see in 2020 that we broke through that 200 week moving average, and we're right on the cusp of doing that right now. And you can see the risk that we experienced in 2008 to 2009. And that's why you have to be very, very careful for and consider the idea that the technicals may break down here, because again, if we're right on the line of demarcation, and there's certainly suggests it reinforces our view that we have much more downside from here. And not to be too negative, what we wanted to also point out the positive. So we do believe that this bear market is going to lead to a brand new bull market where there's going to be significant upside. And we wanted to show the prior bear markets, and then the subsequent upside after the bear markets were over. So you can see in many cases you had tremendous moves after you went through the bear market. So don't fret. You want to miss the next 10 to 15% downside if we get it, but that's going to open the door for just a terrific opportunity. And I just recall going through 2000 to 2002 when we had that tremendous bear market, and then that led to a triple-digit year for me in 2003 after that 2000 to 2000 whipping. So we're extremely bullish. We just don't know where the bottom is, but we think that the market has to capitulate and panic and have that last whoosh down before you put in a firm bottom, to the bear market.
Yep. That's right. All right. So now we'll go through a couple of regular charts, monthly charts for us. Just another look at the S&P 500 on a daily basis. taking out that low back in June, and also the more recent low back at the end of September. So undercutting that. So now, in our method, right, we're looking for that follow through day. So, now it's going to be 4 to 7 days, right? So at least 4 days for a real follow through day, right? So that puts us at Monday at the earliest. And so, that coupled with the CPI risk and Thursday, it's hard for us to imagine getting invested much here.
But we have to have a positive update before we start counting, for
Right.
the market to open the window for that 4 to 7 day window. And that begins when we have the first day of an attempted new rally.
Right. All right, and here's the Qs showing some more weakness too, undercutting that low. An important level I think that people have been watching. Taking out the prior low and starting that third leg potentially. And the FFTY, we were talking about this last meeting, right? And thinking about, okay, this is down historically, right? An historic amount. And it's got the names that we were interested in, with the best earnings growth, but still has yet to get a bottom. And we'll look at a longer term chart here too, just to kind of show us why these names could be so beaten down that it's getting to a point where there's got to be some value there. And then here's the IBD Mutual Fund Index, just some of their top fund managers, just a look at how they're doing. Looks like they've been able to not quite undercut the lows, somewhat positive. But I think down 30. Well, year to date, we have the numbers right here for all their those components, all those funds that IBD tracks in that index, and it looks like you're basically down 35% on average year to date, and then you add, what is it, 5-10% from the November peak, so you've got things down 40-45% now. From that peak back in November.
And we are approaching levels. Remember, these are A+ rated funds from IBD. And so what this does, it keeps everything in context, that this is what's happened in the growth universe this year. And then you add a couple of more percent from the November top. So, firms like T. Rowe Price, I've been following them for, I think, 20 or 30 years. As well as some of the others. I mean, they're just really getting butchered here. And so they're just really squeezing them to death, squeezing all the, the blood out of the rock, so to speak. And it's really compressing. There's going to be some great values that are from a lot of these funds when it's over. We did see some of these hit down 50% the great financial crisis. Like 50 was the number. So, we're all over it right now.
Yes. And so, okay, here's, we'll look at some technical indicators here. And the MACD on the Nasdaq, we got a false buy signal here with that massive 2-day rally. So, a head fake kind of on the MACD. It's just, one of our indicators, not something that you would always, that you're going to use solely, right, to get invested, but kind of a tricky move there, accompanied with those sort of breadth indicators that people were talking about too. But, this is why we've been acting incrementally, and suggesting that's a good policy. You don't need to be first here, but we're back on a sell signal on the MACD. After that head fake just 5 days later. So in the RSI, we barely got oversold here. But kind of coming close to that oversold level again with the RSI. And then looking at moving averages, this is kind of our number one determinator of trend, right? Moving averages, that's what we like to use. And our kind of intermediate / short-term trend indicator being when this green line is below the magenta line. So the 10-day moving average is below the 21-day. And I think it's done a pretty good job of keeping, you know, us out. You know, even if you get a follow-through day, yeah, you know, maybe you do add some exposure there just out of principle, or, you know, out of having a process. But you know, you'll gradually get pulled in as the moving averages cross over, like this, you know, somewhat sustainable rally off the bottom here in June. You know, probably added some exposure. I think that might have been a follow-through day. You know, somewhere in here, right in late June. And then, you know, as the moving averages and the trend changed, you know, you were able to get a little bit of traction for a month and a half or so. But you know, we're looking for this crossover. We're looking for, you know, the 50-day to turn up. We're looking for everything to be above, or price to be above all of these moving averages. But you know, it's going to take a while for the price to hit that 50-day number, hit that 200-day number. So, you know, I think the thing that'll pull us in is just this sort of short-term trend change, along with the follow-through day. Okay, and we're looking at this is actually the Nasdaq, not the S&P 500, but you know, we were talking about how dominant distribution has been on the tape, and you know, these distribution days highlighted where volume was higher than the prior day, and it's just, you know, day after day after day of higher volume down days. So, you know, it's just a big warning sign of what institutions are doing. I mean, it's not like it's massive volume, which is interesting. It's not like significantly above average days or anything, but still, you know, by definition, just a distribution day. Okay, and then we like to look at this long-term cycle work with Stan Weinstein, and you know, you look using the 30-week moving average. And so here we are, we you know, we crossed over that 30-week for 1 week, kind of, looks like 2, technically closed over it, but you know, ultimately just ran into resistance on that rally, and now we're living back below the 30-week average. And you know, that's his main determinant of, I guess, where we kind of are in his stages 1, 2, 3, 4.
Yeah, and we're looking, we use 2 consecutive closes below or above that 30-week moving average to determine change in trend. So you can see you had there in the 2020 bottom where you had 2 consecutive closes below the 30-week, right there caution you to get out. And then, of course, in the 2018-19 bear market, you had the same type of scenario. So it's utilized more so with an having an exit strategy, and not necessarily, you know, the market's going to be much higher when you cross back over an uptrending 30-week, but it's pretty flawless in terms of getting you out, you know, in a bear market that lasts, you know, 2 to 3 years. So that's kept you out, you know, if you're just looking at that one indicator from a long-term trend indicator this year. So we think it's very important, very valuable. So from this indicator, until we have 2 consecutive closes back above the 30-week moving average, the trend is down. So it's going to be a very difficult tape to operate in. It's going to be very difficult to make money when the trend of the indexes are down.
Yes, that is true. And we'll go, you know, we're actually going into the breadth sort of section of this presentation, and this is what we're talking about, why it's so difficult. You know, you have the percentage of stocks below their 50-day moving average sitting there at just 12%. And, you know, we've already hit that bottoming sort of level before without the climactic action in price. But, you know, this is another indicator, right? We are clearly washed out with so many of these indicators. And so, you know, it's just important to realize that, this is an important level. We once again, we're back here at this washout level, and this is somewhat, it's a little bit of a positive divergence, where you have this higher low potentially in breadth, while the price has made a lower low, right? So one small green shoot. And then here's the 200-day. So the stock's below their 200-day, actually making a lower low on the 200-day basis, along with price, and the index is making a lower low right there. But still, we're getting down there. We've been in an extended bear market. We haven't hit that level yet of COVID lows for this indicator, which was close to zero. I don't know, I can't tell exactly. It probably could have been 2%, but this could actually work a little bit lower. Just the longer we're beaten down like this.
And you're going to hear the old adage that markets crash from oversold levels. So that is the downside risk that's in the market, is that, we know we're very, very oversold. And that's when you get the last washout and the last climactic panic that normally accompanies a great, terrific market bottom. So we're extremely washed out, but that's where it can get really nasty on the last leg down.
Right. Yep. That's a good point. Definitely a good point to consider.
Hey, Roy, Wesley?
Yeah.
Yes.
We talked about these two charts the last time we were down at these tragic levels.
Yes.
And what happened, that's where we got that last bounce.
Yeah.
And I don't know, this just reaffirms kind of the comments I made at that time, that looks like a turnaround point.
Mm-hmm.
I mean, the evidence that you've provided so far in this call tells me, yeah, I agree with you 100% about that we have significant anecdotal evidence that, we got another 15%. But this is saying that we may not, unless that the pattern that we've seen completely valid on the data since 2018 holds that we're due for some sort of a bounce.
Yeah, but we did have a bounce. Yeah, we did have a bounce, Larry. We had the bounce.
You're saying the 3,800 was the bounce.
Well, if you take a look, this chart doesn't, if we just look at the S&P, it'll show you a little bit better. But what's so anemic is the bounce that we just had. These, like the last couple of bounces, very anemic. We had a 2-day bounce there. We had a 4-day bounce there when the market was extremely, oversold. And that's showing you, man, this thing is very, very weak if we can't bounce more than that. So it's definitely, this is a very, these are very extreme cautionary signals that you're seeing right here, that the market can't bounce from this deeply oversold condition.
Yeah, and Larry,
I agree.
You might be right again on that, because I remember us talking about this. And I guess I just look at this. I wish I could highlight exactly, but we're here at that zero level right here, as well in 2020. Right, like March 1st, 2020, it looks like you already hit that 2 or that whatever, basically zero level, and then it stayed there for a month and the market completely unwound. So I guess that is the risk.
I agree.
Wesley,
Go ahead.
Yeah, Wesley, if you look at 2008 or 2002-3 kind of time frame, maybe that might give us better indication whether that's
Yes.
how long it stayed there, not just that it reached there. How long did it stay there?
Right. Yeah, maybe I should pull that
Yeah,
up.
so instead of looking at this one, the better indicator of that is actually, are we making newer lows?
We'll get there. Let's
Right.
Wes, let's get through this part of the presentation, and then we'll pull it up on stock charts.
All right, well, yeah, let's do it.
Thank you for taking the time, because I just think that, you know, everything that you're saying is that we're really on a teetering right now is supported by
are.
everything we're saying.
Mhm.
We are teetering.
Yeah, so let's see, I'll go to, you know, again, this is a positive divergence, so don't want to ignore that either. The Nasdaq above above the 200-day, you know, making a higher low, while price makes a lower low. So, you know, that's another thing I think that supports what you might be thinking, Larry. You know, this is the other breadth indicator. Well, one of the breadth indicators though that will be counter to that, right? We've got confirming action kind of with the advanced decline line, making a lower low, confirming the price action for the S&P. This looks worse, you know, with the Nasdaq, where this advanced decline line is leading the indexes lower. Also, and you know, last time I remember in this June meeting where we were talking about this bottom, that's where we had the trend line bottoming, or you know, trend line here, right? And sort of it looked like a turning point, right? And that turned out to actually be true, you know, at that meeting. But you know, and then this is kind of what continues to dominate our thinking, is just, as you know, it's hard to get bullish, and it's impossible to make money really for on the long side, as your lows are outpacing your highs by such a immense number. This is the Nasdaq, and this is the highs and lows, right? So here's the net number on the bottom. You know, small number of new highs, much larger number of new lows here. So you know, it just continues to dominate, be dominated by new lows. And you know, actually, I'll just go to the 20-year time period where we look at the Nasdaq and the net new highs and new lows. So, you know, this is one of the things that I guess you can kind of compare to 08 and 09 in this presentation is, you know, a year and a half of new lows outpacing new highs consistently through that period. And so here we are, you know, it's been almost a year, I guess, maybe, yeah, probably a year in November of these new lows significantly outpacing new highs. So, you know, if that continues for another 6 months, then that's when we kind of get into that territory of a seriously extended bear market. And maybe you can, you know, picture a psyche of people just getting completely fed up, you know, over time. And it just takes time to get people to give up and capitulate, right? It just takes time in this environment. Roy, do you want to touch on the McClellan oscillator? I feel like you've used this a lot more than me.
This is, you know, this is just a momentum oscillator that many technicians utilize, and you can see the extreme. Just look at it from a context perspective, and look at where the market's bottomed in the past. You can see down there at the minus 420 area, we were extremely oversold, and we got, you know, some of those bounces off the bottom. So many technicians happen to use this, and so we just added it to the slide deck.
Excellent. Okay, here's the VIX. You know, again, this is the fear indicator we're looking for. We're looking for signs of capitulation. We own like a really little amount of UVXY, right? UVXY.
UVIX.
Just the long volatility there. You know, thinking we could get that spike event. But like we said earlier, with the stock allocation survey and things like that are showing, you know, people are saying that they're fearful, but aren't, you know, doing that. So we have not just seen that capitulation. We'll continue to look for it. We may have not gotten it, but we've been saying that for, you know, 9 months that we're looking for it. And you know, this is the area that we're talking about getting, you know, some 40 plus number to show at least just some more extreme level of fear.
Yeah, we just don't think the market is bottom with the VIX sitting here at 33. And we think if we get the whoosh down, the down 10%, the companies lower their numbers, momentum ebbs, people start panicking, people start just liquidating in mass. It could be some type of black swan dislocation event. And then you get that spike to, from 30 to 50 to 60. And we do think that that's the last thing that we need. We just need this technical indicator to flash by along with the put call ratio. And that would give us great confidence in thinking, okay, now we can start going through the carnage.
Yeah, and I know something interesting happened. Maybe some other people saw this in the news. How apparently somebody took a pretty decent position in long VIX like contracts to 150, right? So I don't know what that means, but what someone's thinking with that, but it was a newsworthy kind of interesting. I don't maybe
Yes.
Who knows.
It was $1 million order, so that's a lot of money betting on a 150 VIX.
Yeah. So I don't know. Maybe who knows why people do things for their portfolio. It could be some kind of extreme hedging. I don't know. But okay, here's another sentiment indicator. We're looking at the active manager long exposure. So right here we got this is interesting. We got super low in this active manager exposure level just 2 weeks ago. And like we mentioned, there's a really weak rally as active managers apparently got 10% long to 40% long in this up week. So I don't think it has not been updated for this week, but a contra indicator, right, where if we're super low, super underinvested, then that could signal extreme pessimism there too.
And this is where the bad news can really happen, living below that 200 week. So
yes. All right, and then more sentiment here. We've got the Aaii bull bear sentiment. Extreme levels, 60% bears. It's possible that we just need even more bearish sentiment when you have a really bad interest rate environment, a really hostile Fed to the markets. But we're getting there. It's not a great timing tool, right? But it's important to realize that we are getting at that level that is important, and you can see why it's not a great timing tool, because bears have outpaced bulls for a year now, probably since the November top, and you can again see just how persistent that can kind of be, like in this 08-09 extended period, and then the last time we saw a really extended period was here in 1990. But this is why it can't be a timing tool, but it's important to know, right? It's important to note. And this is what's going to fuel, the big rally that will, ultimately come off the bottom. All right, here's the put call ratio where, we've said we haven't seen a real spike. This is the 10-day moving average of the put call, just with a couple of highlighted points in time where it did reach to, more extreme levels. We've got that 1.15, 1.2 number this year. Again, we would like to see some more panic of put buying. We're seeing a little bit of an upward trending bias to this put call ratio for equities, but again, this is another measure. We're looking for extreme put call volume.
Wesley, real quick question.
Yeah.
Was this same as CPCE, what you just showed? 10-day moving average for the, is that same chart?
This is
CPCE or
different. This is like a total put call volume. I'll have to look up the exact details, but it's total. And this is equity.
I guess this one. Sorry, I meant about this one here. 'Cause
Yeah.
it's equity to equity.
Yeah, just equity. So equity versus the CBOE total. So there's some other instruments included in there. Just equities. Okay, and in the credit markets, we're looking at this. This is our high yield spread, right? So a measure of credit risk for corporate companies. That's been upward trending, and this is something that we'll look at for just economic worst case scenarios. Spreads blew out back in 2020 when there was so much uncertainty and so much risk in credit markets. We saw that spike also in December of 2018. And we're at that. We're a little bit under that level, I guess, of where it peaked in 2018 now, but clearly, upward trending moves in credit risk here. Okay, and we touched on the FFTY, which is had a historic drawdown. ARC, the darling of growth throughout this period, still showing no life, just living near the bottom for the last 6 months, and just giving it all back after the massive run, and a good indicator of the type of bubble that we were in, and a good look, something that will be remembered. I added this in here because I thought it was interesting to start considering more the international environment. And so this is every country x the US, and that we've already undercut that level of pre-COVID highs, right? And we're significantly in that range now. We're down maybe 20% from those pre-COVID highs. So it would not be shocking for the US to follow this and go somewhere in this range, this middle of COVID panic range.
Right.
Something to pay attention to, right? I mean, we're not immune from the rest of the world. We're all very interconnected. Okay, and I did add this in last minute because it's something we've sort of looked at every once in a while. This is Chinese junk bonds, something interesting that's going on over there. That doesn't get a lot of coverage, and their junk bonds significantly below pre or COVID bottoms. So not sure what to make of it, but it's saying there's a lot of credit risk in China too, and it could have to do with real estate over there. We know that there's a lot of over leveraged real estate in China, but this is making a lower low, and it's tough to understand how the credit markets could be this bad, but I guess it's just the persistence of zero COVID, zero COVID policies there, and the economy is just not rebounded. Okay, and Bitcoin, we're still tracking, and it is interesting that they have not made lower lows. So, compared to the U.S. equity markets, actually showing some relative strength in Bitcoin, and Ethereum in particular, 30% off the bottom, right? So while equity markets are now undercutting lows, Ethereum and Bitcoin looking much better. I mean, it's not like this chart does not say buy, right? It's below all the averages. All the averages are downward sloping, and we just rallied to the 21-day, and easily could, the bottom could easily fall out here too, and retest the lows. But interesting to see this divergence, I think, because it's been in the news. All the horrible news has maybe already happened. There's going to be consolidation in the space. There was not the merge, but I guess the fork or whatever of Ethereum to the new proof of stake, which is apparently supposed to be positive for price action and new supply, new supply of coins. And so something interesting, like if it could lead out of the bear market, while people have given up on it and just think it's a complete scam, when in reality, you know, the poor actors will get weeded out, and the technology still got great potential. Okay, and then a couple more here, but gold we've been looking at, and you know, this has just been you know, beaten down by the strength in the dollar. So you've got higher yielding, stronger dollars competing for gold. So, you know, for now, clearly in a downtrend, being shorted up, you know, shorted at the, or hitting resistance at the 50-day the last 2 times here, last 3 times really at the 50-day. And then this long-term chart, you know, we'll continue to watch it, but you know, wondering if we can get a move above this line and see a significant breakout. When, you know, we got faked out here. I think we may have tried to, or I tried to buy a little there, but just got faked out on the massive, hopefully massive breakout that was that it reversed immediately and came back into the base. Okay, and I, you know, went ahead and looked at this US dollar chart way back. And we mentioned something about how not use. So the numbers that we got are the dollar accounts for 96% of trade invoices in the Americas, 74% in Asia Pacific, 23% in Europe, and 79% in the rest of the world. So it's an extremely like important currency just for overall functioning of the economy, of the global economy. And so when you've got a move like this, it's gonna make things, it's gonna change things. And you know, if we were to show the Great British Pound, you probably saw in the news that hit an all-time low versus the dollar. We don't have that here, but notable, right? So you know, the currency markets clearly just they you know could be disrupting things. Okay, here's WTI. You know, really just watching this for bounces to see if you know, inflation can rear its head again and reaccelerate. Maybe, you know, potentially WTI will be an indicator that we're gonna have to worry about accelerating inflation again. For now, it doesn't look like the move has been big enough. You know, the bounce was significant off of the low here, but you know, I guess that is what happens in downtrending markets. They will bounce. So you know, hopefully, I guess if we're concerned about inflation, this should be, you know, one of those things that that will turn into a positive on a year-over-year basis, meaning negative, you know, on a year, like positive for inflation, meaning that it's moving lower. And natural gas, just another commodity to take a look at. It's an input for a lot of things. It's been a problem. It's been a you know, the big move in natural gas being a huge problem in Europe in particular. So, you know, different prices in Europe than the US, but just another commodity to look at. And we sort of touched on yields already, the 10-year and the 2-year and the 30-year. Just notice the 30-year making an all-time high here. The 10-year knocking on the door, and the 2-year, you know, near an all-time high as well. And then just the inverse here, we've got the TLT inverse 20-year US Treasury bonds. All right, and we talked about corporate credit too, so that we looked at those high yield spreads. And so as high yield spreads expand, we've got the high yield bonds, you know, declining in price. So, you know, this is another thing to look at for those, you know, for the credit risk in the economy and everything. Again, I do think the bank earnings could be interesting this week. It might give us a better clue into, you know, what the higher risk lending market might look like. And here's J&K, just a similar measure of you know, a similar measure of that junk bond market. All right, and that is it for our prepared slides.
Okay, and Wes, let me see, let me view my sharing options. And we're back here. And what we'll do now, guys, let's take a 5-minute break. And then we'll come back and we will talk about individual stocks. So let's take a 5-minute break and we'll get started right at 8:30 for the second half of the program.
Oh, dang. Roy,
Yes, Chris.
I got one for you. Turkey, TUR, Turkey ETF, TUR.
Sure. Yeah, give me a couple more minutes here, Chris.
Oh, okay.
Taking a look at things. Give me just a couple of minutes.
Okay, cool.
Okay, Larry. Okay, guys, let's get going. And let's talk about let's talk about some individual stocks, and we'll just go through a number of these. We'll pull up anything that you'd like to pull up, and we'll just take really sort of a fast-paced approach as we go through some of these as we search for some leadership. Okay, Chris, this is the Turkey ETF. You can see it's got pretty good relative strength. I'm really surprised at how this is holding up, particularly since the emerging markets are doing so poorly. You know, as we prefaced in the All World Index, you saw that. What do you like about the chart, Chris?
Like you say, the relative strength, and I
Yeah.
noticed, like in September, September and August, like the market was kind of going down. It was like still moving up. I mean, pretty strong too. So I caught it in August.
Yeah, I'm very surprised. I mean, this is one of the few, this is one of the few countries where the relative strength is so high. And, certainly, it's got a decent looking chart here.
Yeah. I got World Global ETF that I keep track of.
Yes.
It was like it was just like standing up stronger. Yeah,
Right. Right. Let's take a look, guys. This is where the leadership has been, and this is the Market Smith Growth 250. So this is a screen that's made up of 30 different screens that IBD has put together. So it's a proprietary screen that's only found in this platform on Market Smith, but it's used to really identify who the market leaders are, and there's typically not more than 300 stocks on this list. When the list is under 300, that reflects a poor market environment typically. But what I did want to, what I wanted to point out is that solar has been a leading group in the market over the last 3 months, and solar is sort of rolling over now. So, you're trying to find and identify what are the top industry groups coming out of a bear market, and what stocks are holding up in those industry groups. From Bill Neal's studies over the years, he found that you really wanted to buy the top 2 stocks in the industry group. And in the solar group, the top 2 stocks were certainly Enphase and First Solar. And we'll take a look at those as we go through the list. But a lot of these stocks, they have rolled over. And when you're looking for new leadership, you can see the medical biotech stock group. And this is where I think the leadership is going to come right now. Most of these stocks are holding up, and they have very, very good numbers, and they've been out of favor for years. So this is certainly, the door is open. You can see all the medical and biomedical stocks, biotechnology stocks that are in this list. It's populated quite nicely. So you've got leadership there. You've got the refineries because of gas prices. What's happened there? You've got refinery. We know we've got full capacity working in our refineries today because the shortages, in terms of oil. So that's leading right now. You have some computer networking stocks like Digi, ANET. They've been leading. The oil and gas stocks were number 1 at one point. So they've retracted, they've retraced and come down to the number 10 industry group. So the risk is always that the leading groups don't stay at the top for very long. But you can see the oil and gas stocks, quite a few of oil and gas stocks are on this list. And this is a conundrum to me because they have the best numbers. They're under-owned. They only represent about 4.7% of the S&P 500. But, if we go into a recession, like in the great financial crisis, oil went from 100 to 30. So if the market, and the economy weakens, despite what's going on over in Russia and Ukraine and what's going on over there, you would see demand destruction potentially over here, and that would lead to lower oil prices, dollars per barrel. And I think these stocks would potentially go lower. And this is what I wanted to just pull up a few of these and show you how, quote, how the worms turn. You've had end phase that had terrific numbers, and we've been talking about this since it broke out a couple of months ago, when it broke out on big volume and the stock was up 10% in price and volume was up 300% higher than normal. And you can see that the stock recently has undercut the 50-day moving average. And so it failed. So technically now, this stock is under all the averages. It's living under the average. And I was looking at this with Wes, and there's a potential that a lot of these stocks like LNTH, Enphase, Shockwave, that all growth managers have on their books, that these can come into the 200-day if we get like that last leg down. So that's what you have to be afraid of here. But Enphase was we categorize this as the #1 stock in the market based on its volume and its earnings growth. But this isn't very good action operating below the 50-day. So there's Enphase. First Solar was the other stock that's been holding up, and it broke out on big volume as well. In fact, this is the only one that's still holding up in the solar group. So you've had this massive move and a consolidation. It tried to break out, and then there was immediate selling and distribution. So I think this stock is at risk now because of the distribution as well. And if you just look at some of these, they're getting them all in the group. So Sunpower, see, it's gone from 28 to 20. Sunrun, this was a leading stock going from 40 to 25, down 33%. So they're ripping the Band-Aid off, if you will, on these. I'll pull up a couple of these. Shockwave, for example, has everything that you're looking for fundamentally, with the stock with triple-digit earnings and revenue growth. And of course, they've got the product that heart surgeons use to decalcify arteries in hearts using sound waves, and it seems to be being widely adopted. So the product's great. They've got really significant numbers, but the stock is now operating below the 50-day moving average. So there is risk in the stock. And what may happen if we get the next leg down, you're going to see a number of these stocks go right there to the 200-day. So, it's at the moment, it's got very strong relative strength, really good earnings, but the market environment is hostile.
Since we're on Shockwave, does anybody know what happened after hours that it's up 4%?
Okay, so it's up $10. I haven't seen anything after market, so apparently there's some sort of positive news after market, which is well welcomed for sure. I could see it on my other screen, but I'd have to pull up my research platform to see it. But apparently positive news after market, so that is indeed very welcome news.
Morgan Stanley gave them a price raise. I just checked it.
Oh, they did. What's the price target?
They raised the price target to 290 from 255.
Okay, so 255 to 290. Now it's going to be interesting to see if they sell into the price target raise, or that's going to be very interesting to see what happens. So I would definitely not, in this market environment, you don't want to buy a gap up when there's overhead resistance. So a lot of people might use that as an opportunity, a gift to unload some of their shares.
Roy,
Yes,
and maybe for Wesley, actually, the trucking stock, can we look at CBLG?
that's C.
VLG. Victor, yeah.
Yeah.
Right there.
Yeah.
Wes, do you want to talk about, would you like to talk about the trucking?
I remember that I think what happened there in July, by the way. It have been July. I'm pretty sure a lot of this was like takeout rumors. Because if you pull up USAK, it's kind of that same it's a small trucking company, USAK, low quality, small market cap. Okay, so it may have already gotten taken out. So I think that's a lot of what it was initially, right? That initial move was like potential takeout expectations because of a peer. And these trucking companies, the debate here is peak earnings, right? Peak earnings are in, but valuations are low. And these things are early cyclical, so you do kind of want to buy these in a recession, typically, so trucking, I think, has a lot of potential to perform pretty well despite all the horrible news. One thing is they're actually kind of a variable cost structure. If they don't need the trucks, they'll just sell the trucks. They don't have to, they don't have a lot of leverage. They actually have really good balance sheets typically. Covenant, not as much. They're getting there on lower quality, but they usually run these things pretty well with super low leverage, close to zero. So I mean that's kind of what I'm thinking there. I think that you could be warming up to some of these trucking names because of their early cyclical nature.
What about the downward revision for next year? Is that a concern?
Yeah, I mean that's the debate for sure. It's like, okay, if they're trading at 10 times earnings, so let's say they're trading at 10 times, their valuations can expand to 18 times, right? That's 80%. But then maybe earnings have to come down by 50%.
What's that symbol, Wes? See what?
CBLG is what we were just looking at.
Okay.
And CBLG, in particular, their earnings could go down by 80% in a down cycle because they're such a low margin trucking company. I'm not as into it now, but that is the debate. It's like, okay, valuations should expand as numbers come down just because they're a cyclical company. But if you want to look at somebody more interesting, I think you should look at Knight or TFII, KNX or TFII. Those are two of the best run trucking companies, and they both have kind of individual idiosyncratic reasons for why they could go higher.
All right, thanks.
Now, remember, guys, that, we just got a sell signal on Dow theory. So we had the Dow making a new low and the transportation index making a new low as well. So, keep that in mind. And, I was looking at Federal Express. So that's a warning that FedEx came out with, a few days ago. So you can see what happened with that stock. And so they announced a pretty large slowdown in terms of their businesses. And so you can, keep that in mind. There's a big slowdown in retail and big slowdown in shipping and packaging. And that's the risk for companies such as Amazon and, other technology companies that are going to have to report this earnings cycle, that are going to have these tremendous currency translation problems. So, we're looking for all these stocks like Microsoft, Amazon, Apple to miss and guide lower. And we don't think it's that are in their stock, that those are in the stocks yet.
Roy,
Yes.
Jim Breaks up. Why, if what you're saying and what I'm hearing is that we're in a very unhealthy market,
Yes.
that there is a possibility of another 15 to 20% downside. So why would you buy anything right now?
We're not. I mean, what we're seeing is that if you buy something perfect coming out of a base, and we typically want to buy stocks not at new lows, but are at new highs, all the stocks that we're following that are breaking out of bases, they're getting into the high territory, they're failing. So just, keep in mind that what's going to happen is that, the stocks are going to decouple. The good stocks are going to decouple from the averages. So you want to pay a lot of attention to the stocks, but what we don't see right now, we don't have setups where stocks are coming out of great healthy bases because the market environment is hostile and unhealthy. And so one of our go-to I guess guardrails has basically been the trend. So when the trend is negative, the way that it is right now, and this is something that I picked up after the 2000 to 2002 bear market, I found that I had to have some type of exit strategy to just get me out of the market, because in a bear market, in a downtrend, 3 out of 4 stocks go down. So at the end of the bear market, you're going to have stocks that start to perform and that are going to become the next new leaders, but they're not going to be from 52-week lows. They're going to come from 52-week highs. And so you've got to be very discriminatory, and in a really healthy market environment, you're going to have 20 to 30 names that all go to new high territory. We don't have anything like that right now, but we do see some green shoots in stocks like the biotech stocks, like Vertex Pharmaceuticals. This is one that's doing $8 billion in revenues, and you can see it's got a 95 relative strength, and the stock is just basing. Think of this as a tennis ball underwater, and there's pressure. It tried to break out there at 306, rebuffed, came back. It's just going sideways. So this stock is just going sideways as many of the other stocks correct. So you have a number of these that are showing up. Vertex, Neurocrine Biosciences. So you can see this stock actually broke out yesterday to a 52-week high. And the reason that you want to be looking for stocks like this is that the next new market leaders are going to go up 100, 200, 300% from the bottom in the bear market. And so they're going to have to come from stocks that are exhibiting strong relative strength, not making 52-week lows. So the biotech area, it's clearly where the leadership is right now. But just as we looked at the solar stocks were leaders, and then they've all come in. So this is where the leadership is right now. So these individual stocks, they're not going to get off the mat until we think that you have bottoming action in the market. This is where you want to be focusing your attention to. And, Lilly, it's a $300 stock, that can go to 600 and, over the next year or two. So this is, some of these stocks have been going sideways for a long period of time. This has actually been in a nice uptrend, so for forever. But stocks like Vertex Pharmaceuticals, it's gone sideways for a couple of years.
And they've already decoupled, really if you look at the daily, they're not anywhere near the June lows like the indexes are. And, and all the solars are not even near the June lows either. So
yes,
hopefully these are hopefully we do have our eyes on the right ones when the general market is at our back too.
And you may or may not know some of these names like Regeneron. So we have our eyes peeled on these stocks that are actually making money. And this is where Wall Street's, this is where Wall Street's going right now. We don't know if it's purely defensive because these drug stocks are defensive, or if this is truly the next new leadership that's going to take place. But relative strength will keep you in those names. You can see some of these names, you may not have heard of. I mean, I didn't know who Sarepta Therapeutics was before, the last, 30, 45 days. But this is where you can identify those stocks that might be the next true market leaders. So you have to, you've got to be screening. You're looking at the right things, looking at the right stocks, and we just see there's a proliferation of these biotech stocks that we're getting to know them better, more and more, because the next new leaders aren't going to be Apple, Google, Netflix, Microsoft, Amazon, and Meta and Tesla. They're just not. The next new bull market is going to be composed and comprised of a great new list of leaders from a different industry group. And we think that these right now, this is where you need to be concentrating your time right now in terms of finding those.
Roy?
Hey,
Yes.
Maybe paraphrasing. So is what you're saying that this is the time not to be buying so much, but really setting up that list? Is it easier? I mean, in your experience, was it easier to spot the really strong stocks that weren't going down in 2008 and 2020 based on this type of action, and then you kind of go in to buy when there's a season change?
Yeah, let me point something out. I was talking to Wesley the other day about this. So when I went through the 2000 to 2002 bear market, and I think I had a drawdown of about 25% for that 2.5 years. That was the internet bubble that popped. And so you just wanted to stay in the game. And let me just show you what I found. And I want to show you what to be looking for. And I'm going to take you back 20 years. And get the date right here. Okay, so we experienced a very difficult bear market in 2000 to 2002. And this is March 2003. And I bought this stock. I'm going to show you a couple of stocks that I bought. And this is how you can make your year. Okay, you want to find the leadership, and you want to find the next new market leaders. And those next new market leaders, they must be making new highs. So that's one thing to keep focused on. If your stock if it's not making new highs, or it doesn't make new highs, then there's no chance that it can be one of these market leaders. And you can see here that we actually went a couple of years where this stock didn't do anything. It tightened up, and then it broke out on volume. And that was, I think, March 26, 2003. And so you had your 10-300 day where the stock was up that day on volume. It was up 8%. It was up 25%. And volume was 300% higher than normal. That's what you want to pay attention to. So you can see this stock went from 12 to 35, went up to 40. So you made 4 times your money, in the next 6 months. And right there, this is how, if you've had any kind of a drawdown, when there's going to be opportunities like that. Sohu was one, Sina that's no longer traded, I believe, was another. and then NetEase was one. And so you had an industry group move into new high territory on big volume. And so right now, we just might be in a period here where you go sideways for a couple of more months, and then some of these drug stocks break out. And you can see here how important it is to find those stocks breaking out into new high territory. You can see here, the stock went from 16 to 70. And, I had a triple digit year in 2003 because I was buying all these stocks. I was in the right stocks at the right time after a bear market. And that's what you want to be looking for. You want to be studying, using relative strength to identify these, but the game's not on until they break out into new high territory. And one of the things that you need to be looking for is an earnings report. So, earnings are just starting in October, and you want fresh earnings numbers. Normally these stocks break out on volume on an earning. That's typically the catalyst, is an earnings report. So you've got to screen every day to find these stocks that are moving significantly higher, on an increase in volume. So they're going to be there. So there were a number of these, Sohu, Sina, NetEase, that, you had big years, and that made up for the last 2 years of the brutal bear market that we experienced. You got it back in 30 days. So that's what I'm looking to do, is find these stocks that can go up, double and triple, over the next market cycle. And Wes and I like to look typically over 8 earnings quarters.
Roy, can I ask you to look at, and I'm not sure exactly how to pronounce it. I think it's Aaii, A-E-H-R, as one. They just announced earnings and had a big move. And then the other one is Lpl Financial, with the ticker symbol being LPLA.
I love LPLA. And actually the group's sort of firming up. You can take a look at Schwab. We'll take a look at a couple of these. So you had an earnings report. Now, the problem with this stock right now is it's a very small stock. The market cap's only 430 million. So you're not going to have any institutional money. I mean, not a lot of institutional money that's buying it because it's too small. So it may give you, as an individual investor, a decided advantage by buying something that's a smaller cap stock that has, that are truly reporting great numbers. So you had the stock that broke out perfectly in this downtrend a few days ago. Earnings were up 350%, but granted, this is a small base that they're looking at. But I passed on the stock because they only did $10 million in sales. So you're not going to have any institutions that are really, buying this thing heavily with a company doing $10 million in sales. So this is something that would be preferable, not for institutions, but for, a smaller retail investor. So, it's got pretty good action here, but the numbers are just not large enough. I want to see big numbers like Shockwave, LNTH, and names like that. If you take a look at LPLA, this is really what you're looking for in terms of a really nice liquid leader, a $200 stock, some great accumulation, higher than normal volume, accumulation. I mean, some really good attributes here. And the stock it's sitting there in new high territory. So this is a stock that's on the top of our watch list as well. We really like it. It's got a $19 billion market cap, and very nice size, and and great numbers next year. This year earnings are going to be up 51%. You want to buy companies where that are expanding their margins and these numbers are going higher. So this is one of the few stocks that actually fits the bill. And the only thing that we don't like is look at the revenue growth. The revenue growth is slowing. And so you don't have 25% revenue growth, but you're going to have tremendous earnings growth. So that's a little bit of a yellow flag, a little bit, but you've got a lot of A+ funds in this stock. This is definitely a leader in that investment banking group, and the group is fairly strong at 36. So we like
Is
it.
the increase, I'm sorry, is the increase in interest rates one of the fundamental reasons why they're making a lot of money off the float, and that's why they're going to increase their earnings so much?
I really haven't taken a look at the breakdown. I don't know how much they make on the float there, but I think maybe it's just coming out of a bear market. So, this bear market is going to end, and when it ends, business at these firms are going to explode, but I guess it's kind of a leading indicator. So they are going to do a tremendous amount of fixed income business, and that might have something to do with it. Not necessarily the flow, but the fixed income part of the business. But we do know the equity side of the business is going down. But there's going to always be a place for really solid financial advisors when you go through a crisis like we're going through today. And I think they're the largest and probably best independent financial advisory firm, I think, in the country. So they're well respected.
Thank you.
You're welcome.
Hey, Roy.
Yes. Hi.
This is Amy. I just wanted to
Hey.
share some additional information on trucking. I work in used trucks. I'm actually in finance. And
Okay.
it's kind of a really interesting time to be in trucking right now, because for the used trucks, their prices have basically doubled over the last year and a half. Now the prices
Right.
are starting to go down. But with the interest rates going up, we're squeezing out a lot of the owner operators. So right now we're selling to a lot of fleets, but then the fleets can't get all the new trucks they need just due to production constraints and supply constraints. And so you have this pent-up demand for these trucks, and there aren't very many trucks. So a lot of these companies now are going to undesirable trucks with undesirable specs and a lot higher mileage. And it's just going to be interesting to see how all of this plays out.
I'm wondering, Amy, what do you think, if we go into a recession, and I guess are you familiar with the Mannheim Index?
I'm not.
Okay, so that's the organization that measures used car prices, and they're the ones that measure that. And it's been an anomaly where for a while in the past year or so, you've had used cars that were priced more than a brand new car. And obviously cars are assets that depreciate, not appreciate. But there's been some imbalances there. I'm interested in what's going to happen there. I think CarMax, they're telling you that you're going to have a slowdown, I think. So I would expect used trucking prices to crescendo here, to put in a top. And as business declines and we decelerate here in the economy, I think that you probably have got peak pricing, and that will sort itself out, in the next few months.
Yes, it's already starting to do that. We're starting to see that.
Yeah. So I'm wondering, like, what's the trade there? What could you short to take advantage of that? Here, you can see what happened to CarMax, the same thing that happened to Carvana. So, that stock Carvana from 376 to 18 in the last year.
Been the short for used trucks.
What's that?
Ryder's always been the short for used trucks, but I think they've got this underlying bid by like private equity. or somebody trying to buy them too.
Oh, really?
I think, well, Ryder, yeah, because so much of their earnings, I think, come from high used prices, used truck prices. So, you know, the reverse would be the same. So maybe that's the short there, but I guess that I'm wondering what what happened on that day at 9:27.
Yeah, right there.
Yeah, because back on in
That was
May,
that.
I think that was
You
a
know,
buyout rumor.
that's definitely a buyout rumor. You know, if it's
Yeah.
not earnings, it's buyout rumor.
Right. So that's why it's dangerous, I guess.
Yeah. Yep. For sure. And guys, you can see there's LPL, by the way. See where LPL and Schwab, Raymond James, they're in this, they're in the Market Smith Growth 250 index. Another stock, guys, that we were looking at was this Lantheus Holdings, and they make the Polarify imaging agent for CT scans and those types of procedures. And let me pull up the earnings. And this is just something that we were like going through. This screens. This is the top of our fundamental screen here, where you can see revenues are increasing sequentially. Earnings are got triple digit, far exceeding that 25% that you're looking for. And this is what you're looking for. Look at today's volume. So the stock had sold off a couple of days ago, and this is the highest volume in the last year, as shown by this this balloon demonstrating that the volume was there. So you had a reversal here. And we're just wondering if a number of these leading stocks, if the market takes a next leg down, if they all go to like the 200-day. And then you're going to have to decide, well, do you want to, based on the fundamental outlook, do you want to take a position in a number of these names? If they'll just come in to support. And that's something that I would pay attention to, that I'd pay attention to. You really don't know who the next new leaders are going to be until you actually put in a bottom in the indexes and then see who's outperforming. These will just provide you, these screens will provide you clues, but there's going to be some rotation as well. It's not going to be in insurance. It's not going to be in it's not going to be in banks. I don't think it's going to be in electrical equipment. It's not going to be in banks. We don't know where they're going to come. It's not going to be in HMOs like Cigna, Humana. These are places to hide, and they're defensive. But if you're looking at the new high, you should be looking at the new high list. We don't know if there's lithium, Albemarle, Livent, perhaps it's going to be some lithium. There'll be some lithium plays. You've had a couple of these semiconductor stocks, ON and Wolf, that they have terrific numbers, but the area is so weak right now in the semiconductor area. This is something that we were looking at. This has among the best numbers in all the universe that we look at. You can see earnings next year are going to be up 981%. $13 billion company, and they've got great revenue growth, and they're supposed to have terrific earnings in the next couple of years. But it's in the semiconductor group, one of the weakest groups out there. But that's the conundrum on this one. They reported great numbers last time, but the semiconductor group, if you look at NVIDIA and AMD, they're just making 52-week lows. So you don't want to, these are groups that you want to avoid. You don't want to try to bottom fish and guess you know, that these are going to turn into new leaders. These are just devastated and they're cyclical. And when you look at them on weekly charts and monthly charts, don't for a moment think that they're cheap. Wes and I we were talking about this. So this is AMD. So this is not a stock that went from 100 to 200 and it's corrected 50%. This is a stock that went from 2 to 160, 80 times your money in the last 5 years. And it's just had a correction from the top to here. You know, this stock can go to here. You know, it can go to here. It can bottom here. And once it breaks this 50-month, there's really, you don't know where these things are going to bottom. So these stocks that are in big uptrends that break a 50-month, that's very crucial. And you don't want to own any stock below the 50-month. And I'll show you an example of what I'm talking about. Let's take a look at Meta, Facebook. See, notice where it broke the 50-month, and that's the magenta line. This is a monthly area. So it broke it at 230, and now it's down, almost cut in two since it broke that 50-month. So don't think that AMD is cheap here just because it's down 50%. You know, most of these winning stocks go down, you know, 80%, 70, 80% before they finally bottom. There's Teladoc that broke the 50-month. This is one of the big winners a couple of years ago. And see, this is how you have to have these. This is why you have to have exit strategies. And you don't want to get caught in a stock where you have a big concentrated position that goes, obviously, that goes down, you know, 70%, 70 or 80%. But that 50-month is crucial. So on the pullbacks, you know, take a look at all your charts, and you know, as long as they hold above that 50-month, they could be bottoming. Tesla actually did that a couple of years ago. Let's take a look at Tesla. But there's the 50-month in Tesla. See, there's your downside risk. And you know, this is a stock that is one of the most influential institutional companies out there that's had this major move from 10 to 340, 30 times your money. It would be nothing for the stock to come back to 160. And I think that's where the stock goes, frankly. So these big cap stocks, this is where there's air underneath them, and they're going to miss. There's Microsoft going to the 50-month. So Microsoft's going lower from here. And after this big uptrend, and pay attention to those stocks, they don't last forever, guys. Microsoft was one of the biggest winners in the 90s, and you had that same type of move that we just showed. It went up many, many fold. And I was in this stock just like everybody else in 1998 to 2000. But notice when it finally peaked, it took you 16 years to get even. And I think you have to be very, very careful in the cues. So, you know, people are, you know, they're buying these because, quote, you'll hear people say on TV that they're great value, you know, they're great value, they're great companies. But leading stocks peak. When they peak, sometimes it takes years to get even. So don't get caught in the trap. I think all these stocks have peaked. I think Amazon below the 50-month, and Amazon's had this major move. Look, it's gone up for 20-fold. And where's the bottom in Amazon? It's below the 50-month. Is the bottom there? Is the bottom there? You know, where's the bottom? You know, I think many of these stocks have peaked. So be careful. Amazon, I think Apple's peaked. You know, you got to be real. You know, Apple's had this major move for, you know, 10 years. There's a good chance. This is one of the most expensive, quote, growth stocks, and the numbers aren't great. So if this thing gets nasty, see if the index is, see most stocks, we saw the percentage of stocks below the 50-day and the 200-day that suggest the market is washed out. It is, they just haven't gotten these, see these generals yet. But, you know, you've got foreign currency translation. Apple does, I think, about 65% of their business overseas. So they're going to miss just because of the foreign currency translation. So there's your downside. It's 100. So I think, and you know, it doesn't look like anything on the long-term view. You can see this on the monthly. Notice the magenta line, that's the 50-month. It hit the 50-month. It hit the 50-month. It hit the 50-month. And those are bear markets. I think it's going to hit the 50-month before this is over. This is really what you want to be paying attention to. So I have it going to 100. If it goes to the 50-month, it's 140. People are going to be panicking. You can have everybody, you know, everybody that's getting out that they're not, and the stock is, you know, the stock's clearly peaked. There's the all-time high, lower high, lower high. On the bounce, people are going to be shorting it because earnings are going to be, what, 9% this year and 5% next year. You know, there's no earnings growth. It's just a place where people have been, they think it's safe because they have, quote, free cash flow. And if you listen to, you know, people like Stephanie Link on TV and people like that, they're riding it all the way down. But there's the downside. So you've got to define, remember, any position that you put on, it's okay to take 10% losses on these positions, but you don't want to take, you know, 30, 40, 50% losses.
What do you think about Orly?
Of who?
Orly. O'Reilly?
O'Reilly, O-R-L-Y.
Yeah, please.
This has been a, you know, this has been a extremely strong, look at that. It's been an extremely strong stock. You know, it reminds me of, you know, people, you know, we go through a recession, it's holding up because people are going to spend, you know, they're going, presumably, they're going to spend more money repairing their vehicle than buying a new one. And that's, I think that's why the stock has, you know, that's why the stock has recovered. But there's an earnings miss. And so there's a really bad earnings miss. Earnings were up 5% this time. I mean, not great. So I would just be careful. It's, you know, it's holding up because it's a defensive stock. That's what I would say. But earnings are going to only be up 2% this year in 2022. And that doesn't, you're going to find the best stocks with the best earnings growth. It's going to be the ones that have triple-digit revenues and earnings growth. And here, this is clearly a stock that's decelerating with the high PE, a 23 PE growing at 2%. It's something I would be careful. This is something that I wouldn't own. You know, Cardinal Health, see, this is another defensive stock. Pharmaceuticals, over-the-counter healthcare that's growing at 3%. I just wouldn't, I'd rather have money on the sidelines, in short-term T-bills than buy something that's growing 3%. And, you know, this is earnings report. And this is just, you would characterize this chart as wide and loose. And where do you buy it? You know, this is, how do you trade this? And, you know, you're going to find in a new market uptrend, you're going to find stocks that are really tight in uptrends when you begin a new uptrend. There's
what do you think of?
Yeah, go ahead.
Sorry, what do you think of Digi International, DGII?
I really like it.
That.
Yeah, I really like it. let me point this out. I think this is a time to really do a lot of work on IPOs like Airbnb and some of these companies that are dominant, but they're just out of favor. And, you know, because once these stocks make new highs, there's Zoom that made a new high. That was in 2020. You had a move, see, from 100 to 600. You had a 5-fold move. And, you know, and it was an IPO. And it took out the IPO. This is an institutional due diligence phase where they're doing all the research. Then we have the institutional advance phase. See, we need some of these to set up, like who's going to be the next Zoom? Who's going to be, before I get to DGI, who's going to be the next CrowdStrike? See, CrowdStrike, you had the same type of setup, and this is a stock that had that same type of continuity and characteristic, where when it finally got into new high territory, then you had a move, see, from 100 to 300 in a couple of years. See, that's what you're looking for. And all this time, see, it took 2 months to come back and make new highs. And, you know, we're in this period where they're not showing themselves yet, but when they do, be ready to hop on board. And before I go to that one, see, here's Airbnb. And so my point being that when Airbnb takes out 200, it's going to 400. Now, and the better setup is not buying it right here going to 200. The setup is from 200 to 400. That's the best setup. But like that CrowdStrike, you know, you can draw some of these trend lines and you can draw some resistance areas to kind of give you a heads up. For example, when this would break this down trend line, and it's going to take a couple of months, then it's probably game on. So there's a lot of work to be done, and I'm identifying a lot of these IPOs to see, well, you know, who do I want to buy that's breaking into new high territory. So this has definitely got leadership ability, and it's on our watch list as well. It's in that computer networking area, and you have a few stocks like ANET, CLFD that's in the group. We can pull that up, but this is really notable because it's got very strong relative strength, 99. So it's outperforming 99% of the stocks out there. The market cap is really small with 1.2 billion, but the numbers are quite robust. So you can see that they're accelerating their revenues, 79 million, 84 million, 94 million, 103 million, and they've got really good earnings growth. So this is emblematic of a well-run company. That's, it's a smaller company, but it's certainly got really good fundamentals, and they have great estimates this year and great estimates next year as well. So you could see that it's tried to break out a couple of times, but the market is pulling it back in. So I think it's definitely it's definitely buyable, watchable, however you would want to characterize it. I like it a lot.
Could you tell me what you think about MP materials?
Don't like it at all because of the poor relative strength. And this is one, and I own this stock too, by the way, and took a loss in it. Probably back in here, probably in April or May. Oh, I'm pretty sure we bought it when the market turned up, and we had a little rally there, and it made new high territory. Of course, they're in the rare earth mining area, And right now, China, we're getting a lot of our rare earth minerals from China, and MP is supposed to be the U.S. domestic answer to that. But just the relative strength is poor. It's in a downtrend. And the numbers, see, this is quite interesting, is the numbers were so good. So the numbers were great. And, you know, many times what happens is you have peak numbers at the top. And so you had 100 million, 99 million, 166. There's the peak numbers. And that quarter was reported right there. So there's the peak number. And right there. And that was also characterized as the top. So it's below all the averages. It's in poor position to make a meaningful move from here. It really looks, really looks like dead money from here.
Thank you.
You're welcome. Oh, WWE, this is hitting the screens, but this is sort of a takeout play. And so, Vince McMahon was released of the CEO position for some infidelity issues. And now it was a buyout rumor. So, there's a rumor that they're going to sell he's a billionaire. And there's a rumor, that's the rumor that they're going to sell the franchise. And so it's hanging around, it's a well-run, commercially successful entity. And that's the takeout. I think you got the takeout premium there, but this is certainly outperforming now. They've got really good numbers. As you can see, strong earnings growth, strong relative performance in terms of revenues as well. This is one of the few stocks hitting new highs. And if you take a look today, let's see what hit new highs today. This is what, guys, this is what you want to focus on. You want to focus on the new high list and look at this every single day to see if you find something that just pops up for the first time. If you don't find it on one of your other screens. And none of this is that Dice Therapeutics came out with a phase 1 psoriasis pill. And they don't even have a drug. So that's off the list. That was up 60% today. Nothing's hitting the new light. These are just some ETFs. There's really no new companies today that are hitting the new high list. Today we had 18 items, new highs, and we had a lot more new lows. And you can't, you're not going to make a lot of progress when you have that type of background. What else are you guys watching? What else would you like to take a look at?
Roy, I have a question. I have a question.
Yeah.
It's not a stock, but what is your feeling on Thursday? The percentage of the odds of the CPI being 7.9 or below?
I don't think I'd bet that it's going to be over 7.9. I'm thinking it's going to be an 8 number because the big components from last month, that was Brian. The big components for last month were owner's equivalent rent, food and transportation. And those haven't gone down much. The big one's going to be owner's equivalent rent. And there's going to be a tremendous lag there. And so I'm looking for an 8 number. And we're so oversold here that the market's looking for every opportunity to rally. But I think he's short the rally if that happens. And because I think the economy is slowing, it's going to get worse. We're in a recession. It's going to be obvious. And you're going to see all these companies start lowering their numbers. So I think inflation is peaked, but it can stay up here for a while, for a long time. And this is unprecedented because we don't know how long it's going to stay. And the Fed is going to continue to raise rates longer than they need to. And that's going to break something. That's my view.
Thank you.
Any take on INSW, International Seaways?
INSW. That's a great chart. And so, you know, some of these, this is the third, this is the, you know, number 3 industry group. So you also have, and we'll take a look at STNG that's in the group as well. But this is a really, really good chart. This is what you want to see as a potential, you know, leading stock. Look at the revenue growth, 84, 94, 101, 188. You know, it's a small company, 1.7 billion market cap. And it's the strongest relative strength that you can have. You've got some 300 funds that are in there buying the stock. It broke out perfectly at 25. You know, it is extended. Now it's extended. It tried to break out again right there. And accumulation distributions, A-, great composite rating. It screens very, very solidly. So I would definitely keep this on my watch list. I like it. You're not going to have a lot of institutions that buy $1 billion company, but I like this more than we were looking at one of the other before that was very thin. But you know, I think the numbers are, who was that?
It was DG.
Okay. Yeah. Okay.
That
DG.
that was thin as well. Yeah.
Yeah. So, this could, I definitely take a look at this and explore the fundamental side, do some work. Looks great. This is what leaders are going to look like. They're not going to look like AMD. They're going to look like this. So this is when you look back, this might be a $35 stock that goes to 70. So think about it in those terms. It's a very small market cap, and earnings are going to be reported in November. And there's the day to buy it. See, and I didn't buy the stock then, too thin, but that was an earnings. That was earnings. So obviously they raised the numbers, they beat the numbers, and they raised it. So if you have stocks that set up this way in earnings season, those are the ones you want to pay for. You can see if you bought that stock right on the earnings report at a new high and you saw it, you're up 30%, in 2 months. It always looks easier after the fact, but that's what leadership looks like. So it looks great. And you could even draw you could even draw a trend line like that. When it gets over this reversal pivot right there, probably the move is going to be on again. Technically it'll be in a Bible position. It looks great right now.
Thank you.
Thank you for bringing that one up.
Hey, Roy.
Yes.
This is Braden. Could you check out LTHM, Levent?
Yeah. So this is it's a paradox, and this might be a leader too. You can see that the stock, and we actually bought the stock. I'm sure we took a position in the stock here and sold it either the next day or the next day, and it was breaking out. And what we found attractive about this, yeah, this is when you had that rally in that May, June period of time. So it was one of the first stocks that broke out on that rally, and it failed. So the market wasn't ready for it yet, nor was the stock ready for it yet. But now you have this nice cup, and now you've put in this handle. This handle is a little, it's not great because, it's down, about 20% from 36 to 28, about 20. And the handle is below the 50-day moving average, which would be flawed, but they have great numbers. And we bought it because of the numbers, and our investment thesis, and Albemarle is another one that we'll pull up here in a second. Our investment thesis, well, you can have a continued increase in demand for electric vehicles. We don't like Tesla because of the competition. BMW just came out with their beautiful vehicle the other day. Mercedes, BMW, there's a lot of competition now. First mover advantage is over. But, you hear that there's a commodity shortage in lithium, and the three big best ways of playing it that we hear is LTHM, Albemarle, and SQM. And so what I like about it is the numbers. See, earnings, remember you're looking for 20, great true market winners have 25% earnings growth. This has 1,000% earnings growth off the charts. So it's either not ready yet, or I don't know why this stock has come in, but a stock like this, we tried it there. It failed because of the market, the second breakout. So this would, it's on our watch list. It's on our watch list. It's just not acting great. And earnings are 21 days. So you can't hold it into the number unless this is the bottom and you have a little bit of a cushion going into the number. But LAC, this is what got my attention too. See, LAC broke 2 days ago. See, this is another lithium play, and it broke on big volume. So this has made me a little bit reticent. And it's like, man, I don't know about it. And it's not at new highs. See, look, it's way under the old high. And so you have another stock breaking in the group, and they all should be in lockstep. Just when the solar stocks were roaring, they were all roaring. Sunpower run, ARRY, SHLS, SPWR. They were all, you had a group move. And I would say the leader in that group is clearly ALB. And see ALB, and they raised their numbers and raised their guidance, doing big business, a nice market cap. You have A+ funds in it. This is where you want to focus. This is the lithium leader right here, Albemarle. So try to, as you try to put the thematic macro story on and looking at industry moves, try to find what you think is the leader in the group. And the leader in the group outperforms the other by 2 times. When you go back and you look at how initially it was Enphase and SEDG. And SEDG was number 2, and you can see that rolled over. So try to find the number 1 stock. There's SEDG that broke out to all-time highs and then failed, and it's got really sloppy action. So think about that. Think about the industry moves, like what's going to move. What's moving in the industry group. Wingstop, this is on a lot of people's screens. You've got A+ mutual funds in it. You can see I've got it marked up. It broke I had this trend line drawn, and then failed a couple of days ago. Earnings are in 15 days. But this has got a, they're going to, what I heard right here, when it broke this downtrend line, they have a new sandwich that they added, and they sold 1 million. I think Jim Ropel, I heard him quote this. They sold 1 million sandwiches in a weekend, and that was their whole annual allotment. That's what they were planning. That's hard to believe, but there was overwhelming demand for a new sandwich. And this is firming up. So a lot of growth managers are interested in this one. And so this is setting up earnings, though, that you got the earnings risk there. So Wingstop is also, solid numbers on my, it's on my buy list. But where do you buy it? It's got this sloppy cup and a fractal, another cup and handle, fractal within a fractal. This is kind of an interesting restaurant. And this is a very thin stock, only 10 million shares outstanding, but it got my attention because of the earnings growth. And I've been watching this, and you can't look how thin it is. 91,000 shares have traded, but there's the earnings growth, and it went to new highs. And this is, I've never had I guess I had a stock years ago, 5 stores. It was a discount retail store that was that every quarter it grew 10%. And I think this is a Chinese restaurant, Asian restaurant. They're going to open 290 restaurants in the future. And notice the revenue growth: 28 million, 29 million, 31 million, 38 million. Probably they'll do 41 million, 43 million, 45 million, 50 million for years. So this is one that I'm watching closely to see, but it's not, you're getting in on something like this very, very early, but they're going to be profitable next year. Small market cap. If you can go to the site and check out their web page. So this is a very interesting speculative situation, but it hit my relative strength screens, and then the earnings pop got me. I saw it on the earnings pop, but it real thin. We this double verified. This was the only stock that we were holding, and the last stock that we were holding, we had a 1% position, I think, in this stock, and we were break even until yesterday, and it broke the 50-day. And we thought this stock had really good numbers. Earnings are going to be up 174% this year, 23% next year, and really good revenue growth and earnings growth. But it broke through sort of our support area. I think we sold this with a 6% loss today. And in light of the market environment, when it breaks here, you don't know if the stock is going to hold at the 200-day or if it goes to 20. So we took a very small loss in this today. We had a small position in it. If you want to play volatility, you have 2 ways of really doing it. And the UVXY, this is a VIX instrument. And you have this way, and this is what most people are using as their proxy. You can see it's traded 70 million shares today. So it's very, very liquid. And, we're sitting here at 13, and you can see these prior moves. See where you had 50% moves, quick 50% moves. But what's interesting is if you look at, well, what did this do in 2020 when you had the crescendo there? So you're sitting here looking at something at 13 that's trading 70 million shares. Change the date to 2020. Went from 10 to 135. That's what happened. And that happened, within 30 days. So, you get some kind of black swan event and you get the VIX to spike. And that's how you take advantage of a potential VIX spike. And the two ways of playing that is the UVXY. And we have a small position in the UVIX, which is 2 times the VIX, and it just broke out at 15. And this is the only position we have. We have a 1% position. And so you're betting the volatility, and it's just broke out. And, you get a bad CPI number, and this thing goes to 20 on a bad CPI number. But, you're just, or we get some bad earnings over the next couple of weeks, and this thing spikes. We were using it as a hedge, and it's no longer a hedge. It's just a speculative position, and we're up in it about 8%, 8 to 10%.
Hi, Roy. It's Amit. What about your thoughts on shorting with something like SQQQ along with the VIX short?
I think we'll take a look. Here's the Qs right here. So, where do you think the Qs are going? And, I think the next move to the Qs, it's right there. And, I just think that there's your downside right here. So the appropriate mechanism, Amit, would be to, trade the SQQQ, right? So,
Yes.
there it is. And let me change, is that date right? Yeah, reset that to today. And it's just, you've had this big move from there to there, and it's just a tough call. It's extended here, but if the market comes unglued, you can see this thing take off, to new high territory. It's it's extended. 3 days ago it was at 50 something, and it's just it's very, very volatile. Look at just how volatile it was there in the May-June period. So I expect more volatility, but that would be the number one place to go. You can see it trades 134 million shares today. And I do think the Qs are going lower because as I mentioned, Microsoft, Amazon, Tesla, I think they go lower, but you might need an earnings report. See, and that's what makes it so dicey, is that you get we have a short cover and rally. If the CPI would have a 7 in front of it, and people are going to get excited momentarily, but I think that's can provide cover for people to unload some positions there.
Roy, Urban Beard here. Where would you put a stop on SQQQ? Protection stop.
Well, it depends on where you bought it. Where do you buy it?
If I buy it tomorrow, you put it at a percent? Or are you putting at a level like that low line you just draw? Well, maybe at the.
This is so you have to position size into the position. So this is what you have to be prepared for. You don't want to take more than an 8. You'd like to not take more than an 8 or 10% loss in it, no matter how big the position is. And you don't want to take more than an 8% 8 to 10%. So if it just comes into the 10-day, that's 10.3%, and nothing is wrong with it, but it just means it's extended. So from a risk perspective, it's not a good risk reward, because if it just comes in, if you buy it, say it gaps up tomorrow or opens unchanged or what have you, then if it goes to the 10-day just in it could do that tomorrow.
Yeah.
Then you're down 10% in the position. So it's not really, it's not really a great setup. You want to buy on the pullback to say the 21-day. There's a 21-day. So, if you bought this thing tomorrow, I might use, a 1 bar stop. That's today's low. Knowing full well that I'm just betting on the CPI number going in Thursday. I don't, that UVIX is a better setup.
Yeah.
Than this one. It's
okay. Thank you.
Sure. Guys, remember that you can trade anything, as long as you try to minimize the downside. We're looking at a lot of different stocks, a lot of different setups, but we're in a bear market. If you just need to get through this unscathed, and again, this is the 3rd worst bear market I've seen in 30 years. But what's so exciting is we're going to have a triple-digit year. For many of you that saw my U.S. investment championship performance, last year it was quite a year, but just trading. But we're going to have that opportunity coming out of this bear market, just like we did in 2003, just like we did in 2009. So, I wrote on Twitter the other day, just wait on it, wait on it, it's coming. And, make sure that you got capital at the bottom, and, it's going to get easy. It's going to get easy, and you're going to feel very smart, and it's going to be just a new bull market. And, we'll coach you as much as we can in these webinars monthly, but don't get frustrated. Just continue to do your work. And, I think that you need tools like MarketSmith. FinViz has, they have a pretty good screener as well. But this is really the time to do your work and to find those, next, new leaders. So this AZPN, you've got 4 down days. This is on my watch list, and they have decent numbers as well. But there's, it's generating some violations right here, coming in 4 straight days. But this is a potential leader as well. And, one thing to watch, guys, is if you can get a big explosion in volume, on some type of catalyst, and preferably earnings, and the stock's up 10% in a day and volume's up over 300%, key in on that immediately. See right there. So you had 1 day, and I missed this because the market environment was poor and I wasn't sold on it yet. I bought in phase instead, but this stock never pulled back, so I was waiting for the stock to pull back to the 21-day, the magenta line. It never pulled back. And now, now you don't know what to make of it. I actually shorted this today on this bounce back to the 10-day, using the day's high as a stop. But look for explosions in volume based on earnings, and, earnings really start in the next couple of weeks. New companies, new innovation, something new going on, new highs preferably on an earnings report. And particularly if they're biotechs that have numbers, that could be very powerful as well. If they have numbers, I won't be buying any biotechs that don't have numbers. although there's some great setups out there. Okay. Give me 1 second. Let me pull one up that I wanted to show you. PLRX. Yeah, this is like, for example, this is a biotech stock that came out, and what made this so interesting, so it's in a top group, and when all is said and done, it's really the technical action that you really, I mean, that you're really looking for. And they came out with some new treatment or some FDA approval or something like that. Not exactly sure what, but obviously you can see it was very favorable. What was interesting is they did a secondary at $18. The stock was trading at $8, and they did a secondary. I've never seen a secondary priced up 100% higher than the last price, and it was absorbed. You can see where it traded 83 million shares, and the stock is going sideways. And this is what we call a volatility contraction pattern. And this is a perfect setup where it's just come in a little bit, it's come in a little less, come in a little less, and now it's about to break out. And look at this volume right here. You know, very strong accumulation. But they don't have a product yet, and it's $1 billion market cap. But this is exactly what you want to see in terms of technical action. I mean, that's really a perfect setup. And this is one that, you know, you could buy this stock and use that 19 area or the 50-day as a stop as well. But, you know, I'm not buying the stock for clients because it doesn't have any earnings, but this is great action. You know, we call this a power play. We're a stock that's doubled in a very brief period of time, where it doubles in a very brief period of time, goes sideways, and then you buy it on the breakout. And here you got faked out. You're at that 24 area, like you would have bought this at 23, and then it came right back in, and you got stopped out. One, I'll show you another one. For example, people were playing, here's one. There's your power play where it's up 100%, more than 100% in a brief period of time. And it just came into the 10-day, and the pivot point's 29.78. That's where you buy it. You know, 29.88, 29.88. So it's, you know, it's up $10 in what, 10 days, 30% in 10 days. And the only way that you would have caught it is if you're screening it and you see these types of setups. And, you know, I didn't buy this. I bought the other one and got stopped out. I didn't buy this one. But same kind of setup, you know, so something's happened. They did a secondary. It's some kind of FDA phase 1. But there's the setup at a new high. And that's what leaders look like. That's the action that leaders have, where you think it's gone up. Well, you know, I would never buy this stock that's up 100%. Well, that's when they really take off, because there's no overhead. You know, there's no overhead resistance.
Even given there's negative earnings?
It's, you know, it's, those are ones, the buyer beware. You know, buyer beware, you know, that's the technical, you know, if you're just looking at the technicals, you buy it. But, I mean, it's so speculative to just buy something, just pure momentum. But, you know, I've made a lot of money by doing that before, but you have to have an extremely tight stop and realize that, you know, a lot of those don't work. So just buyer beware. So I'd rather buy.
That won't be a true market leader, right?
Yeah, it's you know, maybe, something's going on, there was tremendous buying, tremendous volume, something's going on there. And I watched that, like Biogen came out with, Biogen came out with some type of new treatment. Forget what it was for, and the stock went up, 40% in a day. And this is a volume up 40%, volume was up 1,000%. And see how the stock has come back into the 10-day. So that is institutional buying. I'd rather buy something like this, for something that can go from 250 to 500 over the course of a year. And it's acting great. And it's, they're doing $10 billion in sales, not great growth yet, but they've got a number of products in the pipeline. And, I'm not sure what how these numbers will shake out in the next couple of years, but this was very positive action when you had this breakout right here. And if this stock would turn, it would really get my attention. If this stock trades over 283, we will have this in our portfolios, I believe. So if it takes that 283 out and goes to new high, we'll probably add it. You can see the institutional coverage, several thousand funds on this stock. I'm just stocks like this, you can buy, you can put 5 or 10 million in. Then you could never do that in like DGII or AZPN or some of these without moving the stock. And then if it goes against you, trying to get out is it's an endeavor. It's a big headache. So this is what you want to follow you really want to follow what the institutions are doing most of the time. If you can't make money, in the institutional leaders, then it's going to be very difficult making money consistently.
Thank you.
You're welcome. You can see there's just a hodgepodge we just have a hodgepodge. Don't know who that leader, the leaders are going to show up in earnings. They're going to, during the earnings season. And it may take 2 earnings. It may not be the October quarter, but remember, from Wes, when he took us through the slide deck, I think it was 72 calendar days that we had that 15% drawdown from all those times in the past. That suggests that we're going to be bottoming here before the end of the year. So that, that's, of course, that's just anecdotal, but sort of as oversold as we are, knowing that the market's a discounting mechanism. And the only thing I'm looking for is the VIX spike and capitulation. And I know it when I see it because I've seen a lot of these over 30 years. And that's what I'm waiting for. And I'm waiting for them to come and get Apple and, get, Apple and Microsoft and Tesla and those, and people just say, man, just get me out. And we're right there, one more leg down. And, it's going to be tough to stomach being down 40 to 45%. People are going to be forced out. And that's when I'll know that the low is here. And just as a note, guys, you're going to see one of the things that will determine how to see a bottom is Marty Zweig had an indicator, and Walter Deemer had an indicator. You can Google some of these names, Lowry Associates, and they have various momentum indicators. And these, the chartist has a 90% indicator where we have 90% of the stocks are up for 10 straight days. And normally when you have market breadth like that, the market is very now it's overbought. But when you have that type of momentum, that's just about in every case, the market's been higher a year later. And just to give you a clue, we actually had we had a number of those indicators that flashed about 2 months off the March 2020 bottom. So you're not going to miss a lot. And the momentum is going to come. You don't have to be there right at the bottom. And it's important to wait for a follow-through day so you don't get really whipsawed. And most of these follow-through days that we've had, since we peaked, they've all failed. But the lower that we go, the higher the probability is that the next follow-through day will work. And remember, the follow-through day is a day up 1.7% on higher volume than the day before, and with a window of 4 days to 7 days from the bottom. So keep that in mind, that we're not close. Since we haven't had an up day, we made new lows. And if you're using that as an entry point, which we certainly are using that as an entry point, that means we'd have to have a day. Tomorrow would be an up day. We'd have to have an up day. And what's that? Tomorrow is Wednesday, Thursday, Friday, Monday. Monday is the soonest that you could have a follow-through day, provided that tomorrow is up and you don't undercut that day on Thursday. So that's setting up quite well, because you don't buy. You don't want to be allocating capital on Thursday. We want to see if it'll fail, and that gives you the weekend also to plan your strategy, plan the way that you wanted to attack if we would have a follow-through day on Monday. So that gives you all weekend to construct a trading plan and an investment plan. But what we're going to probably do is, what we would urge you to do is probably not have more than a 5% 5 or 10% allocation if we get a follow through day, because we've had a number of these that have failed. And, you know, we just think that we're going to go lower. We think all these numbers are going to go lower, that we think that's going to constitute the last leg of the sell-off because of the recession. But remember, the market dictates everything. It's not your opinion. You're not going to, you know, but if you get a follow through day and then you get the trend change and you get the crossover, you have to put money to work. Despite as scary as it looks, and that's just part of it. You can't make any money if you don't risk any, but incrementally put money in the market. You know, incrementally, don't have a follow through day and go and put 50% or 100% of your money in the market. Dip your toe in, maybe 4 or 5 names. That's what we'll probably do. And then if they work, then we'll get more aggressive. But we haven't been 100% invested for a year and a half. And, you know, that FFTY for growth, you know, remember this is, you know, IBD, which is really a growth. This is the neighborhood that you're playing, looking for Amazon, Googles, and Netflixes and all that. This is down 54% from its high, and down 54% from its high. And that's why it's been difficult to make money in growth stocks.
Hey, Roy.
This will change. Yeah, hi.
Just quickly wanted to check, do you have any investment service as well as part of your overall portfolio?
Do we have what?
Do you have any investment service?
No, we don't have any newsletters or things like that. We do manage money for clients, and a number of our clients are on this call. So we manage money on a discretionary basis. But we don't provide a menu of ideas or setups or anything like that. You know, Mark Minervini is someone that we're friends with. We talked to him a couple of weeks ago, and we actually subscribe to his service because it gives us confirmation of what we're doing. But it's pretty expensive. It's, I think, $6,000 a year. But you know, that's somebody that we think highly of, and we would, you know, certainly recommend someone like Mark. But he doesn't, but he just gives you a menu of ideas, and then it's up to you to make the selections. And we find that, I mean, it's great, but you have to be sitting in front of your screen every single day as well. And, you know, some people are willing to do that, and other people, they've got other responsibilities, but we think highly of Mark.
Thanks, Roy.
You're welcome. Jim Rope was another guy on Growth Stock Mentor that we think the world of. And Mike Santolo of Cabot. Those are three great growth advocates, if you will.
I'm sorry, Roy, who's the third one? Mark
Santolo, Cintolo. And he's in a lot of the stocks that we're in. And that's a newsletter service that we think he's great. So it's a market that, you know, for you to make big money, you're going to need a position trade. We're just not in an environment like that right now. The environments can change. It can set up, you know, great opportunities, but it's the last leg. You know, it's the last leg of the bear market that you have to. It's painfully obvious that you must respect, and you know, you must miss, you know, that last leg. And you can see there's that March 2020 bottom. It's that last leg, and that this is I think this is the weekly. And so we're set up, you know, to go. This is the pre-pandemic high, see right there. And, you know, I think, you know, this just took place, you know, in a couple of weeks. You know, I think that we could get this type of crescendo undercutting. We undercut that low. And, you know, we're in that period where I think, you know, it's possible that we can make a bottom here. You know, I think that you're going to make a bottom. And you can do Fibonacci retracements, but I think you can make a bottom somewhere between there and there. But guys, look, it's possible. It's possible this thing turns into a 50% retracement. This is the Nasdaq. We're down 35. It would not be out of the question for us to come down here and have a 50%, you know, retracement, the way that we did in 2007 to 2009. And this is the monthly, and see how we're in this period right here. Look at where we broke the 50-month, see? And it was over in 2 months. There's the low. But that last 2 months, you were down 15%. See, boom, boom. So that's what you have to be careful. That's what we're trying to be very diligent, very disciplined, because we know that the last 2 months, that's where people, you know, throw it up, you know, and we intend buying here, not selling. So don't be premature. Don't try to get there too early. You know, wait for the capitulation, and know that, you know, if you follow me on Twitter, I'll be writing about it. You can follow me on Twitter at Roy L. Maddox. And I will be writing about it, you know, and you can see that. But I think that's what you want to wait for. You want this to happen, and that's going to set the stage for a glorious new bull market that's going to probably last about 5 years. So when you get these types of, you know, massive drawdowns in the bull markets, you know, then you're going to get several years of positive follow through. So this will set the stage for a brand new glorious bull market. So make sure you're there at the bottom, you know, and you don't ride it down another 15 or 20% from here. Anything else, guys? Would anyone like to make any comments? Anyone like to?
Hi, Roy. How are you? Could you check Valmont Industries? VMI?
This is a really good looking chart. So, I mean, it is, look, it's very wide, very loose, 96 relative strength, but I like the price. You know, it's a $300 stock. You've got some institutions in it. You've got an A+ rated IBD fund in it. This is, you know, it's setting up, it's trying to break out, and it looks good. It's in a really good area. You can see that tower structures, cell towers, very solid numbers. So this was one I prefer this type of setup. I prefer this type of chart, you know, because it's just solid. They're making money. They're profitable. They're not being, you know, impacted by the recession very much, and they've got just really, you know, really solid numbers. I like it a lot. Thank you for bringing that up.
Thank you, Roy. If you check it in the weekly, it looks like a really long base and maybe could work for the next bull
Man,
market.
this looks fantastic. So you look at it in the weekly, it looks even better. So this is really one of the favorite stocks that I've seen tonight. And you know, when you look at it on the weekly, this looks so much tighter than on that daily. So man, I like that. You know, so this is, look, it's gone sideways too for, you know, for what, a couple of years, year and a half. And that's exactly, notice when it broke out, see, before we went up for another year and a half, see where it broke out here at 140, then you got a double. Now it's going sideways even longer. The base is even broader. So it's breaking out at 250, and you can see, you know, it's breaking out of the pivot. I really like it a lot. You know, a smaller cap company, but I like it. You know, what's it look like on the monthly? On the monthly, the same thing, looks great. And it's in the 23rd performing industry group. So it's in the top 40 industry groups. So you want to concentrate your buying in the top 40, and you probably have other stocks in the group that are along with it. Confirming, CMC, that's in the group. So you have a few stocks confirming the strength as well. So that Valmont looks great. Many times you'll find stocks like this that nobody's really heard of. I mean, some institutions have, but the retail investor hasn't, and they may be turned off because it's a $280 stock. But just ask yourself, you know, there's that little trick that you play. Move your decimal point over and say it's a $28 stock. Do you think it can go from 28 to 38? Well, sure you do. So it can go from 280 to 380. You know, this is exactly the type of setup that I prefer, and well done, I believe.
Thank you.
You're welcome. Guys, I think that's all that I've got. If you don't have anything else, I hope you got on our email list. I hope you learned something today. Hope it was beneficial for you to stay on the call, and I wish you all great investment success. You know, hang in there. The tide is about to turn, and it's going to be a brand new bull market. So just hang in there. Don't have significant drawdowns here, and we will see you next month. And with
Thank you,
that, I
Roy.
will say good night.
Thank you, Roy.
Thank
welcome.
you, Roy.
Thank you. Bye.
My pleasure. Go get them, guys.